now taking a look a little bit at the valuation basics, really, depending on how familiar you are with valuations, some of this actually may look pretty familiar to you, some may not, but realistically, we solve to essentially two different levels of value. You have enterprise value and you have equity value. When valuing an operating entity or cash generating asset, they have those two values, and that's how we differentiate them between enterprise and equity. Thinking about it simplistically, enterprise can be really summarized as the value of the operating entity versus the equity value, which is really taking the entire value of the enterprise plus or minus any debt obligations, cash that might reside on the balance sheet, as well as non-operating assets that might have claim to the equity holders as well. Now, between these two valuations or these two levels of value, we look at two different cash flows that support either of these value levels you're looking at. Focusing first on the enterprise value, you have what we call the unlevered cash flows. Now, unlevered is looking at debt-free earning streams, and this would be the cash flows available to as well the equity holders, but also the debt holders of the business, and usually is measured by the financial metrics of either EBITDA or EBIT, which you probably are very familiar with. The other value would be solving to the equity, which is using the leverage cash flows. These are looking at what we call the leveraged cash flows, or these are the cash flows provided just to the equity holders of the business. And then after that, you would discount them back by the cost of equity, leading you ultimately to the equity value. And these actually are measured with net income versus your EBIT or EBITDA. Now, focusing for a minute on enterprise value here, slide 14, you'll see here we have three different examples or sample companies that we're each looking at, each of which have $1 million enterprise value, but slightly different debt to equity ratio or levels for each of those. Company A, you're looking at total debt of roughly 800,000 and equity of 200K. You might say that's an 80-20 debt to equity ratio. Looking at company B, you have your 200, it's completely inverse to company A. You have your total debt of 200 and your equity of 800. So you would just flip flop that ratio to 20-80. But clearly both of those still equaling $1 million enterprise value. And then company C would have that equal capital structure of debt to equity. And still, of course, as we mentioned, at that $1 million. One thing to remember here that's important with enterprise value is that enterprise value will not ultimately drive how a business is financed. It's important as well to kind of take into account current levels of debt or cash, as this will have impacts as well on the ultimate equity value of the business. When we go through valuations year in, year out, many of our clients and of course prospective clients are always curious to say, what are the key variables or what are the key drivers impacting my valuation? So first, we try to separate this conversation into two categories essentially. First, you have your internal factors, and then we also have your external factors. Internal factors really are something that's somewhat in your control. And some of those might be, what is your business model set up as today? How diversified is your sales base? How many different end markets are you serving? What are your growth prospects? Do you see a lot of potential opportunity in new markets, new geographies? So these are things that might support what we call to be a stronger business model. As well, we might look at and say, okay, what's your profitability? How have you performed over the last few years versus the prior years? And how are you performing 2 to 5 years out into the forecast? As well, of course, your balance sheet strength is important. Are there any additional intangible assets that might be also driving additional value in the valuation? And then kind of looking internally, you might say as well, how strong is my management team? Are there gaps in the bench strength that we really need to bolster certain areas that really we feel that we have some blind spots? Size is also an important one with valuation. Then finally is capital requirements for the business. How capital intensive are you manufacturing, and you have to reinvest every year into the operations to maintain competitive nature. And then kind of flipping gears, looking at these external factors, and these are kind of ones that we would kind of say are out of our control slightly. Some of those might be market multiples. You're looking at whether or not the public companies or the transactions, are they similar markets or geographies to that of your company? What's the political environment, both national and global? These global events, such as like Ukrainian war, is this impacting my business? Is it trickling down to my markets? And those international markets, of course, can dictate certain elements with your valuation. As well, it's important to understand the market psyche of potential investors as well as the lending institutions. All of these different things really come into play when you're thinking about the different drivers impacting your valuation. Another final point on the valuation basics to really cover would be what we call the earnings normalizations. Every year when we go through evaluations, we try to identify certain elements that may be one-time in nature or non-reoccurring elements that we can either identify and make some type of adjustment to get to a truer representation, both on a historical as well as pro forma financials. So as part of that, it might include making adjustments to either one-time events or elements that might not be germane to the operations of the business. Common adjustments that we make might include excessive compensation for a small family-run business, or if there were personal expenses that are being funneled through the business that we would say that aren't really related or part of the operations. Those would be, recasted both historically, or if they were baked into your pro forma forecast or additional expenses you anticipate, you try to remove those to really try to get to that clean apples to apples picture, both historical as well as into the future. Other items might be bad debt write-offs or extraordinary expenses. This was a really common one, to be honest, over the last 2 years with the pandemic, related to the supply chain challenges that many of our companies and our clients have really faced over the last few years. A lot of these guys and gals are seeing a lot of additional expenses to either have product shipped in if you had an outsourced manufacturing type project. So these were items that we would try to identify and make sure that they were clearly depicted either as a one-time event, or they were justified as either part of the operations, or could we make an adjustment for that. And a few others would be gain on a sale of an asset, or say you discontinued a business this year but you had operations for the last 2 years. We might look back and say, okay, we want to pull out both the historical and potentially any future impacts you might have had on your business as it relates to removing that entity.